If you've bought anything online recently or researched a big purchase, you've definitely seen the shiny PayLater buttons plastered all over the web. It's an enticing offer. Get what you want now, worry about the logistics later. And it makes sense, right? If you give yourself some time to put the money together, you'll be ready when that first payment hits. Boom, problem solved. But it's a short ride from clicking that button to having to rethink your whole 5-year plan. This is First Wealth, and today we're looking at how easy it is to get in over your head with these schemes, how to avoid them, and whether there are any good options out there. The rise of debt traps. In 2024, 86.5 million buyers utilized the services of one BuyNow, PayLater service or another. That represents a nearly 7% increase from the previous year. Initially seen as an alternative to adding a credit card or taking out a microloan, consumers were tempted with instant gratification into entering repayment plans that ranged from 2 installments all the way up to 36-month plans. The business model is nothing new, with the BNPL setup being first famously used by Singer sewing machines in 1840. Their slogan of $1 down, $1 a week became a standard of sorts, with other companies quickly catching on. It was a clever bit of marketing, allowing consumers the rush of instant gratification, keeping sales flowing and profits rising. In time, the concept of interest was applied to the model, and companies providing these services were able to compound their profits even more, with consumers seemingly not noticing the increase in overall costs. Different faces, same scheme. Today, nearly 200 years after Singer implemented the concept, the BNPL business is booming. It's no longer just the companies directly selling the products that are offering the service. Most online retailers have now teamed up with third-party companies to offer BNPL options. And while they are technically legitimate businesses, they target their programs at consumers who are the most susceptible to falling for their game and getting caught in an agreement where they pay way more than they would have otherwise. Companies like Affirm, founded by payment industry titan Max Levchin, leverage their position as a creditor for consumer trust. Because they're a reliable company who operates as a credit card company, customers are more likely to assume a deal offered by Affirm will be fair and reasonable, so they don't look too closely at their pay-in-4 contracts or the interest rates on their 36-month installment contract. Effectively, these come close to being subprime loans. However, due to a combination of low reporting numbers, since BNPL often does not report to credit agencies, and automatic payments, their default numbers are incredibly low. They also offer options that don't necessarily feel like a payment agreement, such as virtual credit cards. It's just a credit card, but you don't have to carry the plastic around in your wallet, right? Well, a closer look at the interest rate on those virtual cards might change your mind. While the company claims 43% of their plans carry no interest rate, their average interest rate on both the repayment plans and their virtual cards is significantly higher than most credit cards and exponentially higher than a traditional loan. There are dozens of these companies in play. Afterpay, for instance, is owned by Cash App, which has the largest consumer base in the under 25 age range and is the recommended go-to app for people under 18. This means the company that facilitates financial freedom for minors also facilitates microloans to them. In fact, in recent months, Block, the parent company that owns both, has been looking to shore up the stability of Cash App by pushing Afterpay into new markets. Shareholders feel confident that the impulsiveness of the online consumer will provide the capital necessary to keep their banking operations afloat. What's the difference between BNPL and credit? The primary difference between Buy Now, Pay Later and traditional credit is that traditional creditors report to credit agencies. So even if you wind up with a long-term loan, you can rest assured knowing that on-time payments will help you in the long run. BNPL also offers options to people who would otherwise be ineligible for credit, meaning a large part of their consumer base is already struggling with maintaining their finances. The subprime loan market is demonized for targeting these same groups, but when it comes to financing online purchases in the moment, that stigma seems to go away. The world of personal finance is huge, with lots of moving parts. Sometimes it can be hard to keep track of it all. We here at First Wealth have made it our job to streamline all the necessary information, making it easier for you to get what you need without all the fluff and wasted time. So give that subscribe button a click, and we'll get back to keeping you informed. How much do you really pay? So how much do you really pay in these arrangements? Well, the costs are spread across several different factors. In many cases, the savvy consumer can get away with these arrangements without paying more in the long run. However, BNPL processing fees tend to be higher than the standard 5% credit card processing fee, meaning there are times where that is simply unavoidable. Merchant fees are baked into the cost of the BNPL model in many cases, so you may not even realize you're paying more than you thought until it's already too late. As we said before, interest rates are significantly higher, meaning over the course of a 36-month payment plan, the customer can wind up paying 35% or more than the initial price of the sale in interest. And while some companies claim to not charge late fees, many still do, and they're typically higher than the average late fee. What are the alternatives? The good news is that alternatives do exist. They may not be as exciting as the instant gratification of the BNPL setup, but they could keep you out of trouble with fees and prevent you from overspending. Personal loans are an option for many buyers when it comes to larger purchases, and they come with significantly lower risk and lower interest than long-term contracts. The average personal loan based on credit will have an interest rate of anywhere from 7 to 10%, which is less than half of the average BNPL interest rate of 20% or more. Credit cards for smaller everyday purchases are an even more reasonable option for most people. And while many American households have gotten themselves in trouble with credit card debt at one time or another, it is a much more feasible hole to climb out of than the 30% interest rate on a virtual card. The most reliable option of all is probably the most boring: plain old saving. If there's a big purchase to be made, the best way to ensure you don't get in over your head on it is just to save for it. There's no interest charged on a paid-in-full purchase. And the final benefit these options have over BNPL is all three of them can improve your credit in the long run. Buy Now, Pay Later programs are a slippery slope and can be the death of your financial independence. They encourage impulsive overspending and are always something to be avoided. Have you heard any BNPL horror stories? Maybe you have one yourself? Hop down into the comments and let us know, and we'll see you in the next video.